Hello, Smart Money 2 podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I will be your host. So today, we're talking with my good friend, John Sneisen. How you doing today, John?
Doing fantastic.
Great. Well, glad to have you on the show again. For the listeners who didn't hear the last episode, John is one of my favorite guests. He's a really smart guy, and he's even from Canada, if you can imagine that. They do have smart people up in Canada, and he is the guy up there. Apparently he's not in politics because there aren't smart people in politics up there. But
yeah, that's exactly what I was gonna say. So you caught me too.
Well, John, I appreciate you coming back on the show. Love talking economics with you. I know people are just going to hit the snooze button from here and from that, but we're not going to talk about we're not going to talk about economics today. We're going to talk about all sorts of fun stuff that's going to affect people's portfolios and how they look at investing. So, John, for the listeners who were unfortunate to have listened to your prior episode, or they didn't listen, it didn't come out right. Maybe you could tell listeners a little bit about your background.
Yeah, sure. My background is actually in telecommunications. I used to do that back home. I'm actually grew up in Norway for 25 years, so I used to do telecommunications and low voltage over there. So got to see a lot of infrastructure and all that fun stuff over in Norway. Then in 2008 I went to a little conference over in Phoenix, Arizona, of all places. My dad had gotten me into some business stuff, and so I went there as a young guy, and I bumped into a guy called Robert Kiyosaki, and of course, me being a borderline socialist from Norway, I was pretty shocked by all the statements that Mr. Kiyosaki said. So I picked up his book Rich Dad Poor Dad, read that, and that brought me down the rabbit hole of many other books. One of the main ones that really brought me down to where I'm at today. That's why I have all this funny money around me. All this currency is Investing in Gold and Silver by Mike Maloney. And I got into monetary economics, and since 2009-10, I really started to do a deep dive into economics, money, and monetary history, trying to understand, what's really happening, because constantly we see prices going up and they're not really coming down that much, other than a few things. So my background since 2009-10, I started something called The Economic Truth, which is an organization that I run with a few other people that get involved from time in and time out. And we look at both monetary history and economics and current events, geopolitics, and so on. And I also written a couple of books, one on the monetary system itself and its history, called The End of Freedom: How Our Monetary System Enslaves Us, and a book on the Canadian economy, which I predicted the crash of the housing market, which is down now 20 to 25%. In Canada, everybody told me, it's like, no, John, you're wrong. Like, housing can't go down. And I was a little early because they cut interest rates right after I wrote my book in 2017. But then suddenly, COVID and everything just the bubble in Canada, the United States is bad, but here it's like beyond ridiculous. So yeah, so I've been doing that for a long time. I have a little podcast myself now called The Economic Truth Report that you can find on my website, theeconomictruth.org. So yeah, that's about me.
Great. Well, I see some of your I guess you call it funny money currencies taped to the wall over there.
Yeah.
Two of them specifically. And I look at that, it's like, wow, one of them's like 1 million bolivars, one of them's 500,000. I want to show you, I've got a stack of bolivars right here. Now, before everyone tries to rob my house, this is probably worth about $20. So don't bother robbing my house, because it's not really worth very much. I do it for, so for all the listeners who don't know this, who haven't been on the website, like, we're giving away free money. So if you want some, go sign up for our free money, and you're going to get one of these. It'll have historic value because it's virtually worthless, but it's hyperinflationary. So anyway, getting back to you, John. So let's talk about Canadian housing, because one thing that was always puzzling to me was, in 2008, housing crashed and certainly the global economy imploded. But places like Canada, people are just like trucking along, and house prices keep going up. And what was going on there? And then what caused it to keep going up? And then what caused it to crash?
Well, so what kept it going up is Canada is, of course, a country. So Canada is in the same boat as the United States, Germany, a lot of the Scandinavian countries. Actually, most Western countries today are in a demographic cliff. So, the baby boomers are retiring. A lot of the middle class, basically their house is their biggest nest egg. So they're relying on that a lot for retirement. So what has happened is that is one thing that the retirees are putting pressure on selling now. But why is it not going down? Well, actually, it's gone down now. Like a lot of Toronto and Vancouver are down 20%. I think London, Ontario is the worst one, around 25, 26% last time I checked, which was a couple of weeks ago. But so what happened is in Canada is that both not just Trudeau himself, but also during the era before Trudeau, we had actually immigration. So skilled labor came in and say basically the diminishing population here that we have in Canada and elsewhere as well. But Canada had a lot of immigration, so that propped up the debt markets, which could have gone into a heavy deflationary pressure. If we didn't have zero immigration, we'll be all like Canada. No, like Canada, like Japan is right now in the 80s. They had a severe deflation. They didn't have the immigration, that we've seen on a massive scale here in Canada. So that has really been the number one, propping up real estate here in Canada. Like even still here in Manitoba, where I am, the middle province of Canada, we're still seeing housing prices just slightly down. They haven't come down a lot yet. The number one reason here is, well, our number one industry is government. So that's a really bad one here, and a good one. If you could look at the housing prices are not down, but that has been a big driver. So what you see in Canada is that when I wrote my book on the Canadian economy, I found out that almost 20% of Canada's GDP is related to real estate. So important to the Canadian economy, which is basically it shouldn't. Your house is not really an asset unless you sell it for a profit or you can make cash flow on your house. A lot of people get angry at me when I say that, but you know, uh, prices are coming down now here in Canada, and people are starting to slowly struggle because the interest rates, of course, is another driver. It's gone up from, near, I think what a friend of mine, she got 1.25% on a 5-year term. We don't have the 30-year terms here in Canada like you have, but she's going to have to renew now, probably at 4.5%. So yeah, that's going to hit a lot of people, especially the people living paycheck to paycheck. You're seeing, 62% of the Canadian population are doing that. So now they're seeing huge problems with their lives and being able to afford things like, I think, auto loans, credit cards, consumer debts is going to get hit hard, and then real estate comes after that. Of course, we got a longer process here in Canada as well when it comes to the whole process of paying mortgages. Now during COVID, also the reason why it's just massive, even further skyrocketing of prices, was moratoriums. I remember the bank kept on calling me asking if I wanted, my mortgage, my credit cards, whatever I had, if I wanted to put on a moratorium, like not paid for a while. And so I think a lot of people took that advantage, and then they had a lot of disposable income suddenly that got spent into the economy. And then, of course, a lot of people spent it on new housing. Suddenly, it's like, I can't afford more now. So I'm just going to go and get a bigger house. And now we're at the back end of that, where interest rates are coming up, the central bank here, Bank of Canada, is trying to fight inflation. But I think we've just seen the start of it. Like this is the first, tranche of inflationary pressures, because our government seems that the solution to inflation is to basically print more money through deficit spending here. So yeah, the pressure, we still have immigration, but now you're seeing a lot of parties, even the liberals here in Canada, are starting to talk about, it's like, immigration is maybe too much now. So yeah, we could cut it off, but we're in the demographic cliff, and we need to replace people that can work. Like we're seeing it everywhere. I talk to mechanics, to electricians to all kinds of people in fields, health sector too. People are struggling because there's not enough people that could replace the retirees. And there was early retirements during COVID as well. So it created extra pressure on, the workforce. And so, yeah, there's so many different, things that happen in the economy that really, help drive this housing boom. But I think it probably, together with my home country, Norway, and Sweden, and I think Britain as well, there's some of the heaviest privately indebted countries in the world. And I think they're going to see a deflation that's going to be pretty epic, but I think the reaction to it is going to be very inflationary as well.
Well, let's talk through that. I wanted to actually, because I noticed that Vancouver was kind of one of those areas that was going through the roof, and I heard there were a lot of Chinese immigrants coming there to buy real estate. I don't know what the economy. I know there were a lot buying real estate, which is propping things up. But I'm curious, because one of the topics that we talk about a lot in the show is inflation. We were talking about it a few years ago before anyone was talking about it, and now we're talking about deflation, and no one is talking about that. And I think a lot of people get confused because, about 4 weeks ago, I came out and made a call and said we might see deflation by the end of the year. Now, I don't think that's necessarily going to be what people are going to see in their pocketbook, but by the CPI, it's quite possible that could happen. So can you tell us a little bit about, this kind of, I guess, battle between inflation, deflation, and why you can have them at the same time and be really confused by by what's happening?
Yeah, so inflation and deflation is the two pressures on any system, monetary system that's out there. You always have had that through history. Now, in a debt-based system, basically the deflationary pressure most of the times is the defaulting on debt. So you get then, people default on debt, they can't pay their debt, so the debt becomes basically worthless. And when enough people, default on their debt, that pressure becomes tremendous. So what you have seen, during a panic, as we had in both 2008 and 2020, is that, they can't have deflation, because if you let deflation prolong, most people will go bankrupt, because when you create money, currency, I should say, not money. When you create currency in today's system, like the US dollar, Canadian dollar, whatever it is, you create $100, and then there's $110 now owed on that because you have an interest charge on top of it. That $10 in extra interest doesn't really exist. So if you pay down every single dollar in existence, you would still have, interest owed, which is basically then pushes it to, in my view, to almost be like a Ponzi scheme, where if you don't have more people coming in and inflating the currency supply by going into debt, creating then more currency in circulation, to then try to pay off the interest in itself, you will have, a collapse. And it's the same with a Ponzi scheme. If you don't get enough investors in at the bottom, there won't be enough to then pay everybody else, and it just collapses in on itself. Now, the pressures that you might see, that, you might have food inflation, and then you might have a debt default at the same time, where you have a deflationary pressure. So you can have an asset deflation, in the stock market, in real estate prices, but you could still have, inflation in the food market and so on. Because what is going to happen is that the government is not going to want, angry people on their doorstep. So they're going to have to, do stimulus now. They just added 300 more houses in social housing, here. Well, they're going to add anyways here in Manitoba, and that's the government's solution to things, is that they're going to subsidize. They're going to give you checks, like we're going to receive a check here very soon, which is an inflation fighting program, they call it here, which when government spends money, that is really the money that goes into the real economy. So when it comes to the debt-based system, when you buy a house, or you create debt into the banking system, a lot of that goes into assets. So you get asset price inflation by, the banks creating bank reserves, as it's called, their form of debt that you see in your bank account that you owe them. So that creates asset inflation, and then when you default on that, that creates asset deflation. In the real economy, the real culprit of the inflation that we're seeing right now is the government itself, because the government had to do mass amounts of spending to keep all the people that they locked down from rioting on their doorsteps. And so they spent a whole bunch of money right into the real economy. They deposited checks into people's accounts. And what did people do with that? They buy stuff. And mostly importantly, they would have to buy food. Because if we don't have food and water, we're dead. So that's why you're seeing, the food inflation is caused by government spending, which is basically then turns into more currency in circulation. And then when you have the supply and demand, there's more supply, prices go up. When you have more supply of currency, it's not really that you have the supply and demand had changed potentially, but it's actually more of a supply and demand on the currency side of things. There's more currency chasing the same thing, which then creates higher prices that way. It doesn't have to be, the supply and demand issues that the economists are talking about right now, where it's like, oh yeah, it's a supply chain issue. It has nothing to do with that we spent trillions of dollars into the real economy.
Well, I mean, the supply chain issue is part of the problem.
Yeah,
I mean, I would say that is what initiated the inflation that we're having, because I mean, we had globalization where you can get, a widget in China for $1 and you can sell it here for 20. Now it's going to cost them $10 to make it. Well, of course there's going to be inflation, right? Because we squeezed all of the, all the inefficiencies out of the system, and now it's more inefficient, if you will. It's just higher costs, so that's naturally going to raise the prices. So I would assume the supply chain's a big part of it. I actually think that was the biggest point, and you and I may disagree on this, and that's okay. I think if money printing and debt creation was the cause of inflation, that would have happened a decade ago, or 2 decades ago when this really started. But why did it just start after COVID? I think that's really the question. Like, all of a sudden it started, whatever it was, a year and a half ago. Like, but why not before that?
Well, so like, remember what I said? I was talking about the deposits into the bank accounts. We haven't seen that before, right? Like, it's actually real cash into the real economy. Now, I purchase stuff from the business that me and my boss are running, and I'm in low voltage stuff, so we buy a ton of stuff from China, ton of stuff. Prices from China hasn't gone up almost at all, Kurt. Like, it's very interesting. A lot of stuff that we buy from China. Now, the stuff that we buy from Mexico, from the US and Canada has gone up 100% almost in price. And that is, like, now we're talking about technology stuff here. And that's supposed to be deflationary most of the time. So stuff from China, we haven't really seen the impact that, everybody was talking about with Chinese, goods and services, being suppressed that way. So we didn't see in our technological, the stuff that we buy for tech, but when it came to anything with wiring that is raw, material, copper, and so on, that's up like 100%. So yeah, we didn't see that, but also remember that, yeah, we had the supply chain shock. There 100% there was supply chain shock, but that is not I think it's almost more like the real prices that we see in the real economy. We're not talking about asset prices. Asset prices usually comes from debt creation over in the banking system. This was actually real currency getting created through, the issuance of bonds, which most central banks were buying. There was nobody to buy it, so the central banks had to buy them. But then they deposited that directly into accounts that got spent in the real economy itself as well. So that's my view of things. Of course, there was things like cars and other things. I seen a little bit of we've had some supply chain issues with some components that get rare earth metals. So we've seen there's a little bit of that, but I think a lot of it had to do with the massive government spending during COVID as well.
So what about So okay, so let's say I'm going along with your thesis.
Yeah.
So why do we still have inflation? I mean, the government in the U.S. we're not printing more money. You know, they're not giving more money out to people, and if anything, they're shrinking the balance sheet. So, what is causing this continued inflation right now? Because all this stuff's not going away.
Yeah, so like the continued, so now what has happened, and we see this as well here in Canada, we had the government here had the CERB, that's the federal government, right? The federal government had the PPP programs and other programs in the United States as well. Now you're seeing the provinces and states have been taken over, having gas subsidies in California, having, rent subsidies. Here in Manitoba, we're getting inflation subsidies and so on from the provincial government. So the provincial governments are the creators now, and the state governments have taken over the role of the federal government right now, that we're seeing. So there's still like that little bit of inflationary pressure here, but I think what we're going to see with the debt collapsing, that's just going to create a cascading, then deflationary pressure on prices potentially. But now we're not going to see our prices just come down like 30-40% on things. We might in the short term see like 10-15% down, but you got to remember, like prices went up 100%. I've seen some prices come down like 2, 3, 4%, but it's still up like an insane amount. So yeah, you can't, like, so the real currency that got spent into the economy through the deficit spending, that is still there, getting spent into the economy. You can't just get rid of, like, the government of Canada, our central bank created, I think, about 15% more cash. That cash doesn't just disappear. You're gonna have to take it in and then burn it if you want to get deflation in the economy on that side. So you're seeing that, like, the supply chain issues now. I think what we are seeing a little bit of supply chain issues. It's not so much COVID anymore. What it is now is food issues and raw commodity issues with the war between Russia and the U.S. through NATO that we're seeing in Ukraine. Because of course, we got the urea and ammonia, like the nitrates that you need to fertilize, and then of course a lot of the wheat supply is in Ukraine and Russia. So you're seeing hits on that. That mostly is not hitting us here in North America because we got our own wheat supply, but it's really hitting African countries and Arab countries hugely. It's like this is the 2011 supply chain shock of food prices going up in 2011, having the Arab Spring basically collapsing those prices because of wheat prices they went like up several 100%, and you're still seeing in African countries, their inflation is up anywhere from 20 to 80% on food. Now the real inflation that you're getting, the CPI, might only be up 15, 20, 30%. But in countries that are poor, that inflation of real things that they need right here now, that's going to really hurt people. So yeah, I'm in the camp that we might see a slowdown in inflation, but I think the governments and central banks are. I just don't see he pulling, putting interest rates up to 20% or something to really calm, doing a Volcker move. Powell or here Tiff McClellan in Canada, because that's just going to collapse the whole economy unless they want to take, the Federal Reserve own everything. Then yeah,
Well,
they're stuck.
All right, so let's get to the point of it then.
Yeah.
So if we think about the economy right now, right, we now have I don't want to call it high inflation because it's really not. Historically, it's probably more normal in terms of where interest rates are, although we're not there yet. So the question I guess I would ask is, if we're thinking about the economy right now, if you're Powell, right, and you're sitting there and you say, what do I do? And you can't say I'm going to end the Fed, because that's not a real answer.
No,
I know you're going to say that. That's not a real answer.
no, I hear you.
So if you're Powell and you're looking at this situation and you're saying to yourself, well, I've got two outcomes here. I could go into hyperinflation if I decide to lower rates, or I could go into a severe recession. So the question I would ask you is, what do you do, and how do you handle this situation? Because neither are good. One may be better than the other, but how do you handle this?
Well, hyperinflation would be devastating, and hyperinflations are not really created too much about monetary policy. It's the initial inflation shock that creates hyperinflation, but the disappearing of trust in the value of money is what creates the hyperinflation. It's not, like per se monetary policy is just the initial shock to it. Then the rest is the population saying, I'm not going to use this currency because it's not, I can't trust it, that has value. Right. So that's the hyperinflationary part. Now, what I think Powell will do is, I think because he sees prolonged inflation, and he's also seen that, the economy still seems to be okay. Now, I believe that the underlying numbers are not as good as they look, because they double count and triple count people, when it comes to employment and so on. But that's what they're looking at. So right now they're seeing like strong employment. You're seeing, the inflation is still, sticky. It's still quite high. Their numbers that they're looking at. So I think they're going to continue to raise rates, because they're afraid that, they're going to lose, get a second wave, no pun intended, but of inflation that might come. And so they're just afraid that they're going to, as Jamie Dimon just said a couple of days ago, it's like the Fed almost lost control of inflation. So they're really afraid of that, they could lose control of that, because they do know. I don't think they're stupid. I think they understand. They've seen other currencies fail, and they understand that it's all about trust, and that's why you need to see the confidence of Powell and others that they're going to take care of this. They're going to have to raise interest rates more, but with that, we're so indebted on the private side. Like private debt to GDP in the United States is 220 something. Here in Canada, it's 305% of GDP. So what you're going to see is that's just going to, strangle the real economy. And I think we're going to have a crash landing. It's going to be like 2008 when Ben Bernanke comes out a couple of days before. It's like, yeah, there's no problem with the housing market kind of thing. So they're not going to tell us the true story. So I think they're going to potentially raise rates again. There was a little bit of a slowdown, but maybe he goes crazy and lifts it to 0.75%, like 75 basis points, and then we might see some severe reactions from that. Got to remember, corporations are in deep debt as well. 20% of corporations are zombies living, just borrowing money to pay off interest. So debt is a real problem. Raising interest rates is going to just cause that deflationary pressure on asset prices, and eventually come into the real economy. But that is going to be the moment when everybody panics. You're going to have probably quantitative easing buying even more than it did in 2020, and then you're going to have the governments, instead of helicopter drops that they did during COVID, we might see the monetary bombers come in and drop a tremendous amount of currency. Just because, like, what else are they going to do? You go and look back at Ben Bernanke's speech on deflation from 2002. In that speech, he clearly states that we might get deflationary pressure, but don't worry, the infinite pressure of the printing press will always win over deflation.
Right. Well, deflation is always their number one challenge, because they don't have tools to solve that realistically. But inflation, they do. And, they don't seem to be reacting in the way that I would expect. I mean, they've been behind the curve with inflation and interest rates for a while now. And I know they're trying to get a soft landing, which, good luck. They have a perfect record of not hitting that target every time they've tried. So I'm not worried about that. But how, if you're kind of if you're looking at this situation and saying, all right, we're going to have probably asset price deflation, but we're still going to have inflation, like food inflation, all these other things. Like, how should people prepare for this? Because one of the things that I took away from the 70s from reading a lot of books is there's mass confusion because people don't understand what's going on. Like, it's a new
Yeah.
paradigm, they don't understand. So how do you think people should prepare for this inevitable volatility and confusion between inflation, deflation? There's just going to be a lot of confusion.
Yeah, no, I think the best way to do it is, having insurance. And the insurance that I'm talking about is, 2,000-year-old insurance is precious metals. Has always, even during deflation, they're there to, keep steady. During, 2022, gold didn't do too much, but it still was performing quite well as a wealth insurance. It's not, I never really look at the physical metal that I hold in my own hands as a investment. I look at it as just my insurance policy against, currency devaluation, which is happening. Because what I see is, you got countries right now, like this will blow everybody's mind, but you got countries right now that have 150% interest rate, 75% interest rate, 57%, 28, 27, 26. And those countries they're still struggling because their inflation rate, for example, Zimbabwe, 150%. That sounds insane, but their inflation rate is not coming down. It's 229. They're not. The problem is if you get the inflation rate too high, you could raise your interest rate up to 20%. But potentially, if you had that loss in purchasing power from these people, they're just not gonna trust the currency's value because we just lost 15-20% of the value of our savings, of our currency that we had. So why that's a huge loss of trust, and that loss of trust could really over time be detrimental. So even though that they raise interest rates, we might see that the fight potentially is not going to do too much unless they can regain the trust from the population. But you're not seeing that much. I talk to people on a daily basis that are actually starting to lose trust in the Canadian dollar because their life savings have dropped tremendously, and also their cash that they had saved up is dropping. Their houses are dropping in value, so they're starting to have a distrust for the central bankers, the government, and so on, that they're gonna be able to save anything here. And when you get that is that dangerous moment that even though how much monetary policy these central bankers try to implement and do their quantitative easing, buying all these assets to try to prop them up, the population itself, I think, is starting to have disdain for, like, and saw what they're being told versus what they see in their pocketbooks.
Yeah, I think certainly one of the challenges that that we're facing coming up is certainly with kind of I guess you could say the geopolitics or the global instability that is kind of hitting us at the same time that we have this high inflation and challenges with monetary policies. So where do you see things going from here? Is the global instability going to make things better or worse?
It's just going to make things worse in my view, because what you're going to see is now, of course, there's distrust because everybody saw what happened to Russia, where they got their reserves confiscated basically, that they had outside of the country. So why should anybody else trust Americans? Why would we trust central bankers and the government? Because they just took away, they basically making it almost impossible for a nation or other nations. Look at Iran, Cuba, Syria, all these other countries that are sanctioned. They still get around it, but they're doing it by going into some of them transacting gold directly with other commodities. Some of them, well, China has their own payment systems that they use, the digital payment systems. So I think what you're seeing right now is the dying last stages of a currency in the United States and a lot of Western countries, even including China. I'm not saying that, China is going to take over or anything. I'm actually in the boat. Like there's some people that believe that China is going to take over, but China has such a massive debt bubble that have been depleting in their countries. So they're in trouble as well. So there's not many countries there that are any strong that could take over as a reserve currency. But now I think what's going to happen is there's not really going to be anything good out there. So I think, you see in the IMF right now talking about maybe that gold might have have a part in our monetary system again at some point. So I think we're heading towards some sort of a reset at one point here in the next couple of, it could be just years away. Really, what you see, like it feels very calm, but the years when bonds and stocks have failed was 1929 and then 1969. Well, those are 2 years before the 33 reset, taking gold more out of the picture in the back in the US dollar. And then in the 70s, they took gold completely off. So, and we had that just happen in 2021, where gold when bonds and equity was down as well. So maybe that's a sign, that we're heading towards something that's coming maybe quite soon, sooner than we think.
So here's a hypothetical question for
Yep.
you. It's not hypothetical because it probably ended up happening, but you mentioned two instances where they pretty much remove gold from the monetary system, which now it's not. So a lot of people think, well, I'll just own gold, and then when they do something, I'll have my gold. And they say, well, yeah, but gold is not connected to the monetary system for the most part. So, we've kind of gotten to this point, and it's not today, but it's sometime in the near future where they're going to have to make a change, right? We've got an enormous debt bubble that the only way they can kind of get rid of it, if you will, is to grow out of it. And I think we all agree that we're not really growing out of it. Could be inflation, which is possible, but there's only so much you can do with that. And then there's the other option, which is like a debt jubilee or a revaluation of assets. Those are really the outcomes. So what do you think is going to happen? Because you can't just remove gold like they did before. That's a simple answer, but there's no simple answer now. So how do they, what do you see as like a logical outcome for where things are going?
Well, it has to be a currency reset, and it has to go back to something. That's what I see anyways. Like, I just don't see any other outcome that they could have, like inflating your way out of it. But the thing is, like, since the 70s, you've been slowly destroying the purchasing power of the average American or Canadian. My father-in-law, he used to have 3 kids and a wife at home in the 70s on one paycheck. No problem. Well, today people have problems having 1 kid with 2 paychecks. So inflating it away, unless we get this crazy revolution, I know the Klaus Schwabians and the people that are into this whole 4th industrial revolution, believing that we're gonna have this great renaissance, going into a technological thing with AI. It's just going to make us super wealthy, and the metaverse, we all going to live in the metaverse kind of thing. When you listen to a lot of people that are really rah-rahing, that kind of movement, they believe that is going to, what's going to take us out into the growth scenario, because we're in a slowly depleting scenario where our populations are shrinking in almost every country now. Even China is struggling with population growth. So we have a massive deflationary pressure on our hands, and we got a massive debt bubble. So those two are not working together. There's, they want, work, so they have to reset it somehow. There's multiple ways of doing it. You could, like, now they're talking about central bank digital currencies and how great, it would be to have those. But those are just control mechanisms, because now they think that, we just need to manage the economy a little bit better. If we had the access to Kirk or John's bank account and we could see exactly how much was in it. We could give them a little bit of money here and there, and really stabilize the whole monetary system. But with that also comes, the loss of all our freedoms. We have cash today for, doing private transactions. So I think what's going to happen is they're going to have an event that's going to be very devastating, with the massive crash in stock market where we're just basically have lost, 40, 50, 60, 70% of our assets. And then they're going to be, hey, here's our solution. Go into this central bank digital currency. And then what we'll do is we'll give you your assets back in that new system. So that could be one of the resets. The second reset is, of course, well, maybe we smarten up and go back to some kind of backing of our currency again, where we can trust that, at least trust for a while, because the gold, the gold-backed currencies, economists, all that fails. No, what fails is the mismanagement, the over creation of currency versus the assets underlying it. So that's what's always fails. So they could go back to, in a desperate move. I think they don't want to. They really want to go into fiat type of currency system. They could have the SDR as an electronic currency trade interconnected, in between countries. But then what they could do is they could have an underlying, they could devalue all of our local currencies, like the US dollar, Canadian dollar, Norwegian krona, whatever currency you have. And then we have those digital currencies, but we've never used the special drawing right that the IMF has their currency. But it would be used for global settlements between multilateral corporations and governments. So that's their fiat system. So like, there's not much here. Like I think they're going to be forced at one point, because what we're seeing is all the inflation and everything. My worries, though, is that the population is going to be just worshiping the government coming in and taking over everything. And then you own nothing and be happy, kind of thing. That's my worst case scenario, is that the population is going to be scared and not understand what happened. What we got to understand, this currency here, the Weimar, this is a $10 billion Weimar note. What came after that? It was a socialist revolution when Hitler took over as the Reich Chancellor of Germany, and then guess what happened after that? So yeah, we got to really watch what will happen, because you hear a lot of rhetoric of just giving people money and all this stuff, and taking nationalizing things and all this stuff. It could be a cycle as well. So there's few outcomes that are, but a lot of them are very dangerous for both our freedoms and our assets.
Yeah, I couldn't agree more. I think we're in a precarious time that requires, people to be kind of astute at what's going on. And I'm not sure how much we can do, but I think, preparation, whether it's financial or mental preparation, I think are really important. So, we're kind of coming up on time here. And John, I know you and I could probably talk for hours, and I'll definitely have you back on, because I feel like there's so much more to talk about. But where can people find more about you?
It's very simple. Just go to theeconomictruth.org and you'll find links to my podcast that I have and to all my content. I create a lot of infographics and stuff. So if you're interested in macro, I actually have a new report out on, I think 50 central banks' balance sheets. And so I track them on there. I show their, composition of their balance sheet. A lot of banks ended up buying stocks and bonds and corporate debt. And so there's a lot of them that are bought a lot more than the Federal Reserve did per se. So I think we're going to head towards that. So yeah, lots of great things that you can find there with infographics and things. I tried to put, all the data that I found into a picture for people, so it's easier to understand.
Awesome. Well, John, once again, thanks for joining us in the show, and look forward to having you back in the future.
My pleasure. Thank you.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with John. Really appreciate him coming on the show again. Love having him on. Always challenges my thinking and gets me to think outside the box a little bit. Now we're into the panel portion of the show. We have our very own Barb Friedberg. Hey, Barb.
Good day, everybody. Happy to be here.
Glad to have you on again. And we also have our very own Megan Gorman. Hey, Megan.
Hey, it's great to see you guys.
Great to have you as well. So, Barb, let's start with you. So what were some of your takeaways from the interview?
First off, the economic theory, the monetary policy, inflation, deflation, that's a lot to swallow. Stagflation, and I think if you get too up in the weeds about that, look, we're in an inflationary period now in, early March 2022. Prices are clearly going up. Interest rates are clearly going up in an attempt to try and pause that inflation. So that's the reality today. We also know, as John mentioned, last year was the first year in nearly 50 that we saw stocks and bonds decline in the same year. Now, does that portend a huge recession, a huge reversal? I don't know. He did a lot of predicting on that interview, and although, look, I'm curious too. I'm interested in what people predict, but I believe we have to stay really grounded on what we know today and behave in a way that uses the information we have today. We don't know what the future brings.
No, I appreciate that, Barb. We're going to get into that more. Megan, what are your thoughts?
Yeah, Barb, I think it's really great that you bring that up about predicting, because we're sitting here today. It's probably, a few days after the crash of Silicon Valley Bank. And one of the big takeaways, you have with all of these sort of challenges about the market and all the predictions, right? I mean, you constantly are waking up to news articles that this is going to happen or that's going to happen. And people trying to predict is nobody actually knows what's going to happen, right? I mean, Silicon Valley Bank, if you had told anyone 2 weeks ago, this is where we'd be at, most people would be shocked, right? It's unexpected. And I think that goes back to something we've talked about in a couple of other episodes. And Barb, you brought it up today about there's been this whole debate, is the 60-40 dead? Is diversification worth doing? And I think one of the things that I saw over the past week with everything that's happened is that diversification actually helps us all, right? And I'll give you an example. When the Silicon Valley Bank, crash happened and they went into receivership, what was required of investment firms is to go into due diligence mode, right? To go through the portfolio, speak to all the asset managers, and look for what we call direct and indirect risks. Now, in most of the portfolios I looked at, we had people that might have owned 2 shares of Silicon Valley Bank because it was an S&P 500 manager, right? So very, very limited loss. So I bring this up because what I find interesting about listening to people predicting about what they think that's going to happen is human nature is often to go to the most worst or best case scenario. But really what things like diversification does is it allows you to hug the middle and ride through both positive and negative news in a very steady way. And so, I think if you have been diversified during some of this challenges over the past couple months of 2023, not 2022, when everything else was down, I think what you're finding is you've mitigated a lot of your risks.
So I want to give a little quick lesson here for the listeners, because I think we're touching on a point that's really important, and we've talked about it on the show in the past, but I think it needs to be reiterated here, especially given what we're talking about, is that we as human beings tend to want to predict things. What's the stock market going to do tomorrow? What's the weather going to be like? Who's going to win? We all think we have an answer, right? Oh, this person's going to win. The weather's going to be X. The stock market's going to go up. This team's going to win. That's how our brains work. We are prediction machines. We are trying to predict the future based on our experience and our pattern recognition of, this team is the number one team. They're probably going to win, right? Or whatever it is, right? That's how our brains work. And yet at the same time, nobody knows the future, right? Barb, you know the future? Megan, you know the future? No? Oh, well, maybe I'm just the idiot here.
If I did, I wouldn't be in this job.
You'd be on a beach somewhere, or you don't own your own island. Yeah, I mean, so think about it. Like, that's what we do. We all do it. And you know what? People in our industry, we do it too. We're saying, oh, we're going to predict this is going to happen. That's very normal because people want to hear that. They want to hear definitiveness of the future. Now, the way around that is, do you have to retrain your brain to understand that's happening and do what we call scenario-based thinking. So outcome-based thinking is how our brains work. Scenario-based thinking is a version of that that doesn't allow you to get pigeonholed into one outcome. So the one outcome is the problem. I'll give you an example. When Hillary and Trump were running, George Soros bet very heavily on Hillary winning for president. And he was wrong. And he lost billions of dollars because he was heavily in one direction. That is outcome-based thinking. And obviously, none of us have billions of dollars, or you probably wouldn't be listening to the podcast. But if you had $1 billion and you were doing that, that's obviously a bad idea. A better idea, and not to one-up George Soros, because he's probably one of the best traders of our era, but in hindsight, what would have been a better idea is to hedge your bets, right? To make a bet, but also understand that if I'm wrong, and if I'm very wrong, then I could lose a lot of money. So scenario-based thinking is saying, how do I act if this happens? How do I act if this happens? So you look at multiple different potential outcomes and saying, all right, if this outcome happens, how do I react to it? And that way, not only do you have different game plans for if different things happen, but what you're actually doing in your head is you're training your brain to not get overwhelmed with fear. So if you were prepared for a bank failure, then this would have been like, all right, whatever. It's just another bank, as long as your money wasn't in there, of course. But if you were prepared mentally, then you say, okay, great, it's happened. Like, what am I going to do next, right? And of course, you would have already had 250,000 under because you would have been prepared. But the point is, the fact that you're mentally preparing for something, a crisis or a challenge, will actually help you address that challenge in the moment and not do nothing and not freeze, which is one of the common things that people do, is they freeze. And I want to get this leads into my next question, is in my experience, like 2008, a lot of people froze, right? Whoever you're working with did a bad job, and you're like, hey, you shouldn't have done that. And they're like, yeah, I don't like my person. They were terrible. I need to do somebody else. I'm just going to wait till the market comes back. It's like, what kind of solution is that? I'm going to wait till the market comes back. You're going to wait 10 years? Like, that's silly, but that's how people react because they hadn't thought it through and they're overwhelmed with the information. So I wanted to put this in there as a lesson, because all of the stuff that's happening right now, which we're going to continue to talk about here with Silicon Valley Bank and Signature Bank and potentially others in the next 10 days, you need to understand how to think about things. If you understand this, it'll help you better prepare for potential problems down the road if for whatever reason John is right. So I want to throw that out there, but I want to go back to you, Megan, because you deal with a lot of clients. Is you've seen this before, but how do you help people kind of overcome this, because it's such a big challenge as investors?
Yeah, I mean, it sounds corny, but talking, right? So during the good markets, we talk a lot about, the basic fundamentals of investing, the science of it, right? Asset allocation, why we have targets and so on. And then we often talk about what do we want to do when markets have challenges, right? So, market goes down, your large cap exposure is now off target by 2%, your fixed income exposure is overexposed. The technical answer is you trim from fixed and deploy into large cap. But I think it's talking about it in the times when things are good that allows people to have a plan. Because I think, Kirk, the challenge is when crisis happens, people feel the need to do something, right? They want to act.
Yep.
And for most people in challenging markets, doing something really is deploying very small amounts from one asset class to the other. They shouldn't have to reconfigure the entire portfolio. And so it's a lot of that type of discussion. And, a lot of times it's, God, what do you wish you had done in the 08 crisis? Like, I wish I had had the money to buy up houses. Trust me, I made clients buy houses. And a lot of them talk about the fact that, yeah, I did do some stuff, but I wish I had done more during that time period. Same thing, March 2020. So I think, we have this great, with our performance reporting system, and I'm assuming, Kirk, you have the same thing. Besides showing performance numbers, we can show the growth of the portfolio versus the market and the ups and the downs. And I think it's about having those discussions about what do you want to do on the downs, as well as what do you want to do on the highs, right? How about locking in some gain, because it works in the inverse.
Yeah, no, I appreciate that. Appreciate that, Megan. Barb, what about you?
This is all really good information. So I think the idea is you don't want to panic. Bad stuff happens all the time, and sometimes you forget it. For example, during the last 10 years before 2022, we saw an incredible boom stock market. And I'm sure many people were thinking, I've got to put more money into stocks. I've got to put more and more and more in. I've got to up my allocation to stocks because I don't want to miss out, FOMO. And so this is where we get back to the psychology of investing. And this is where an investor can, a financial advisor can really help you to see the bigger picture. And the key is when you're investing is you want to keep a balance. You want to prepare for risk. And you prepare for risk by two ways. One, you have to be educated. You have to understand that markets, economies, they go up and down. If you've ever looked at a chart of businesses, markets, economies, they're going up and down. Don't be surprised. And then you have to have an all-weather portfolio. Trading regularly does not work for most of us. And you've got to face that. The data is very clear that other than making small allocations, you're best off choosing an asset allocation, which means a mix of stocks and bonds for the long term, and then stick with it. And that'll be based on your goals. That'll be based on the tolerance you have for a decline in the market. And there was all this talk about the 60-40 portfolio, the 60% stocks, 40% bonds being dead when interest rates were hovering around 1%. Well, yeah, it sucked to see your cash earning literally nothing. But wake up. All of a sudden, interest rates are going up. You can earn 5% on a treasury. Okay, maybe 4.75 on a short-term treasury. So all of a sudden, and your stocks are questionable now in terms of, are they going to go up? Are they going to go down? We've seen them go down. So now the 60-40 portfolio looks really, really good. So takeaway, don't be rash. Don't have more than $250,000 in any one bank. Okay. Because that's all the insurance they have. And don't have 100% in stocks or avoid fixed income unless, you're 20 you have a high tolerance for risk, and you can keep yourself from jumping in and out of the stock market, and you plan on staying invested until you're 65.
Yeah, Barb, I wanted to follow up on one of the points you had made, the point of the all-weather portfolio. And I wonder if you could kind of dive into that a little bit, because I think, the term means something for the three of us, but it probably doesn't, probably people missed that and what that really meant.
In typical portfolio construction, okay, so when you're starting to invest, maybe you're investing in your 401k, and they give you a whole bunch of choices. Stock funds, bond funds, a target date retirement fund, which I personally really like. That portfolio will give you a certain amount in stock investments. If you're 25 or 30, it might be 80%, 90% in stock investments, and say 10% in bonds. An all-weather portfolio is determined by, number one, your age, your goals. If you have a long time until retirement, you can afford to take more risk, and you can afford to have more, go for potentially higher returns, albeit with more volatility, by investing in a greater amount of stocks. So an all-weather portfolio is an investment portfolio that fits your goals, your risk tolerance, and is in a relatively set amount of stocks, bonds, cash, and even maybe alternatives, commodities, real estate. And you determine that either on your own with an online calculator, or at a robo-advisor, or with a financial advisor. And you stick with that until your situation changes, not until the market changes, because the market's going to change. And where you get into trouble is you see stocks taking off and you say, screw this, I don't want any bonds in my portfolio. I can't miss out on earning that additional 1%, 2%, 5%. The key to investing is, if you're well invested, you are going to miss out at the top, but you're also going to miss out in the losses at the bottom. Does that explain it, Kirk?
It absolutely does. Thank you, Barb. And I also want to kind of bring up a point, and I want to give Doug Heagren some credit here. He always talks about, if you don't have something in your portfolio you hate and you want to get rid of, then you're not diversified. I think that's probably one of the best quotes I've ever heard about diversification. So I want to give him all full credit of that, even though he's not on the show this week.
Well, and I have to say, my fixed income portion of my portfolio and my international portion and my value stocks up until this year were like, is it really a good idea to be this diversified? That's what's going through my mind as you seeing those kind of putter along at a very low rate of return. All of a sudden this year, I'm a genius. I've got previously underperforming assets, which are now doing well. Value stocks are doing well. International is doing well. Cash is doing well. So you need to be diversified.
Yeah, and to put a finer point on it, I think what Barb meant is international was doing well. I think as of this week, it's a little bit nutty. So when this episode comes out, who knows what's going to happen in the next 10 days or so.
That's why you're not tweaking your portfolio every day.
Right.
Literally, unless you are a trader, and traders, like I've said before, the data is not with traders. Most people are not successful stock traders and don't pick the best time to get in and out. Unless you're a trader, you can set an asset allocation, and then you can look at your portfolio once a year, twice a year, 3 times a year, and you don't need to do anything else.
Yeah, no, I think that's a good point. And given the markets are changing all the time, ideally, we talked about earlier about prediction on the show and, not predicting. But I think it is important to recognize changes in trend. right? And I think that, we can't predict the future. We should recognize like, oh, well, what's changed, and do I need to change my outlook on things? Is this a sign that instead of a 60-40, it's a 70-30 or a 50-50, or, so Megan, how do you kind of look at from a big picture standpoint when you're looking at allocations and clients? How do you kind of assess the allocation? You kind of keep it as like typically like a 60-40, or do you adjust it according to different trends, or how do you go about that?
Yeah, no, it's a very good question. First of all, there's a point of all this investing, right? And the point is, you are trying to achieve a goal. For most people, it's to retire comfortably and always, feel that you have income coming in. So a lot of times what my team and I do is when we're running long-term cash flow scenarios, and if you work with advisors, they're often called Monte Carlo scenarios. We run it, when we present one to a client, we're presenting one version that we've probably run 20 different scenarios on, right? Because we want to see if a client is in a 70% equity, 30% fixed income allocation versus a 50-50 versus 60-40, where do we get the level of success that we're looking for? And then in understanding the client's psychological, profile, will they be able to withstand those risks? Right. And that's the science that you have to take this idea of return and apply it to your modeling. And I think that that's one of the things that most investors miss, is that when you're looking at how you do over the long term, right, and your advisor says, hey, you're annualizing at 6.4%. Okay, great. What have you run my long-term numbers at? Are we running it at 6.4%? Does it mean I'm successful at age 95 and I still have money in the bank? And that's where you need to take the data and apply it to what you're doing. And I think that that's really important here, because when I've been showing clients performance over the past 18 months, and by the way, as crappy as it is showing clients performance, I do feel I am accountable both in good markets and in bad markets. I also feel very blessed that I'm able to show a multitude of years, right? Over the past decade, right? Inception to date, you've annualized at this rate. So yes, in 2021, we were up, 18%. And last year we were down 15. This year we're up year to date 3. Ultimately, we're getting to the number we need that ties into our overarching modeling.
Yeah,
I don't know, Barb. Barb, you're nodding while I'm talking. So, do you have a follow-up on that, or anything you wanted to add?
I'm enjoying the conversation because it's important to make educated guesses about the future. And we make those based on historical models. That's what the Monte Carlo scenarios do. They use a lot of historical information. They plug it into a program and they say, based on what we've known for the past, however long the time is, it 20, 40, 60 years, these are the likely potential scenarios. And they may be right, they may be wrong. We don't know that, because as we said at the beginning, we don't know the future, but they have a pretty good likelihood of success. And so I'm smiling because you take a conservative figure. So I was smiling when Megan said like 6.4% projected out to the future. That's close to a number that I use when I'm analyzing my own portfolio, because I think it's reasonable, based on a 65 stock, 35 fixed portfolio, which is what I personally have. Mm-hmm. And I can hear you out there. I can see you going, 6.4%? That's nothing. Well, it's reasonable if you have a stock and a bond portfolio. And the fact that we had stratospheric returns in the stock market for 10 years does not mean that it's likely that we're going to go back to 13, 12, 14% returns. So you have to understand his history. You have to have, I believe it's great to have conservative projections, Because if you're wrong, it's more likely you're going to be wrong on the upside than wrong on the downside.
Yeah, and I wanted to touch on something that Megan was saying in in the kind of the variance of returns. So I posted something on LinkedIn. So those of you who don't follow me on LinkedIn, we put out a lot of helpful knowledge on LinkedIn about these kind of topics that we talk about in the show. And one of the ones that I put that actually blew up, it was I don't want to say it went viral, but it was probably one of the better posts that's come out, is talking about the difference between range and average. So when people talk about an average, like, oh, I got, like, on average, the last 10 years, I got, 10% a year. Well, that average is actually a very small percentage. That 10%, well, let's call it 8 because 10's a little bit high, but let's say 8, I get 8% a year. Well, people think, well, I'm just going to get 8% every single year. Well, not unless you're with Bernie Madoff. So unless you're with Bernie Madoff, you have a range of returns. And the percentage of returns that fall in that 8%, let's say, like, 6 to 10 or whatever it is a very small percentage. And so if you look, the calendar year returns between 5 and 10% is maybe 10% of the range. There's actually a bigger range that is above 20 or below negative 20 than there is between that small range. So the point I'm making is that while we think that on average you're going to get 8%, the variance is enormous. It could be 30, it could be negative 60, it could be 0, it could be all over the place. It's rarely 8. I think it was 2012 or 2011. I don't know. It was one of those years where we actually got a 0% return, which I don't know if that's ever happened. That was comical. But the point is that range of returns it's important to understand that there is a range. But most people, when they just hear 6%, 8%, 10%, they're just thinking, oh, well, I'm just going to get that. And then last year, people are like, what happened? Why am I not up 8%? Well, I don't know. Do you live in a cave? Because if you turned on the news, you'd know that everything was down 20 to 30% last year, except for pretty much gold and cash. And I think gold was down a little bit, but I mean, and energy was up. But basically, if you look at, the range, it's important to understand the range will be all over the place. It's the average that over time you'll get that average, assuming that average is accurate. There's actually a lot of assumptions that go into that average, but I think the point is to understand the difference between average versus range. So, I don't know, Megan, do you kind of talk about this with people? Because I know if people don't understand this, they just, you have to keep having the conversation over and over and over again about why it's not the number that they have in their head.
First of all, I think one of the things in working with an advisor that's really important is that you should be in a repeatable process. And I say this because we're used to talking about this stuff all the time. But I do find that clients, sometimes we're the only moment where somebody's saying this stuff to them, right? So I do think you consistently have to have the same discussions again and again, because advisors need to be consistent with clients and clients need to be hearing the same consistent messaging. So, for me, to some degree, meetings have a similar theme. Because again, I'm trying to be consistent in providing the data that I'm giving to clients so that they can make decisions. So I don't know if that answers your question the right way, but I'm very focused on the consistency because so much around the investment market is so chaotic.
Yeah. No, that's good. That's good. So let's kind of move on in the interest of time here. We got to wrap it up, but I did want to touch on, we talked about how earlier in the show and how predicting is kind of a fool's errand. So we're going to wrap it up with some predictions. So let's talk about kind of what's going on. I just want to get kind of sentiments from both of you. I know that this is a fluid environment. SVB Bank and Signature Bank were taken over by the FDIC over the last weekend, and there's a lot of disarray in the markets globally. So I guess, what should people be thinking right now, given the fact that there's a lot of unknowns and maybe a lot of uncertainty? Barb, you've been around a lot of markets. You've seen this a few times. So how should people be thinking, and how should they be, preparing themselves in their portfolios given what's going on?
Let's talk about banking. And let's bring it down to a really personal level. If you have more than $250,000 in one bank, you should transfer that out into another bank, because Federal Deposit Insurance Corporation insures your bank deposits for each Social Security number up to $250,000. I heard on the local news, I live in Silicon Valley, a startup founder goes, I had millions of dollars in SVB Bank, and well, you're an idiot, because you should know your deposits are protected only up to $250,000. Now, our government has said they'll collect a little fee from all the other banks to make good on the deposits above $250,000. Regardless of my own opinion, that really helps sentiment. It'll help people from being totally freaked out or scared. But the rest of us, as long as your assets are under $250,000, you really don't need to worry about this. It's a lot of noise. Is there going to be some contagion into other industries? Is it going to cause a decline in the entire banking industry stocks? Well, that's what's happening now. But I ask you this, is it all based on reality? Are those banking stocks that are well capitalized and really not at all at risk of having more people want to withdraw their money than they have assets available to fulfill those withdrawals? Those really solid banks, is anything going to happen to them? Very, very unlikely. So this may be a little controversial. Don't take my opinion. I'm not giving an investment advice. But sometimes when you see a crisis, like a big decline in the stock market, or a big decline in the banking sector, or a big decline in the housing market, Megan, of 2008 through 2011, there may be an opportunity for those of you that have a little extra cash on the sidelines to go in at some point and say, it looks like these assets have declined more than is reasonable based on the fear in the economy now. And maybe I should buy some of them. Maybe they're on sale. Maybe I want to buy a banking sector ETF sometime because it might be a bargain now. So I throw this out. I'm not telling you what to do, but I'm saying just don't panic.
Great. And Megan, what about you? What are some of your thoughts?
I mean, I think the thing is, it's about controlling the controllables. You cannot control the market. You cannot control crisis. But what you can do is you can control your risk, right? And so when you look at your asset base, from your bank accounts to how your house is titled, to your mortgage, to your portfolio, you should be going through and understanding, what is my biggest risk here? And have I taken the steps to mitigate it? Barb brings up a great story. We have watched all of these Silicon Valley venture capital people talk about, well, I had $100 million in my bank account. Well, that isn't good risk mitigation. And I will tell you, as someone who invests in the private markets, that concerns me that you wouldn't realize that that was a risk, right? So, so in that case, you should go through your balance sheet and on each asset, stop and ask yourself, have I mitigated all potential risks that I can control? And so in the instance of the banking, to Barb's point, stay under the FDIC limits and work with the bank. Because if you have a joint account, each of you get $250 for joint accounts. So that's $500,000. And then sometimes the banks let you add a beneficiary to an account, which adds another $250 of coverage. So there's ways to increase your coverage in order to mitigate risk. Same thing in portfolios. As I talked about at the beginning here, yes, I had clients that had like 2 or 3 shares of Silicon Valley Bank, right? Because of the managers we were in, but the risk was very mitigated. We were talking about a $400 loss. As someone said to me, oh, I guess I'll just skip Starbucks this month, right? And they were joking about it. But that really, to me, sums up the fact that they had done really good risk mitigation. And the other place that we don't talk about a lot on this show, where I see risk in portfolios, is asset titling and beneficiary designations. once a year, go through and make sure you have really updated your beneficiary designations to reflect your wishes upon your death. With all these changes with the Secure Act, it has gotten more complicated in terms of doing beneficiary designations, but it's also the cheapest estate planning out there. And then the last risk mitigation tip I would give you is make sure you have an umbrella policy on your home and your auto, right? Because your home and auto only cover you liability-wise up to a certain percentage, up to a certain dollar amount, and an umbrella lies on top of that and protects the entire asset base. So control the controllables, focus on risk mitigation, because that is the best way to ride out markets like these.
Megan, I have a question for you about
Yeah.
the umbrella policy.
Sure.
Do you believe that people should have an umbrella policy that covers their entire net worth?
Well, for most Americans, yes. I have clients that we can't do umbrellas that big. So after you get above 20 million in umbrella coverage, it's very, very costly, right? So you do different things to mitigate risk. But yeah, I mean, if you're sitting there today and with your house and your accounts, let's say you're sitting there and you've got a net worth of 1.2 million, I probably would have a $2 million umbrella policy, to be honest. And I would also make sure that there's no gaps in coverage. So we talk about the fact that bundling with the same carrier gives you savings. But what you want to make sure is that as the last dollar pays on your homeowners, your auto, your umbrella policy kicks in on the next dollar. You never want there to be a gap. So for instance, you don't want your umbrella policy saying, your homeowners or your auto should have $250 per person, $500,000 per occurrence, but your auto coverage is really only $150 per person, $300,000 per occurrence. That's a gap in coverage. So these are the things you should be thinking about and looking at to protect you from the uncontrollable things that happen to us all.
Great. Well, thanks for that piece of wisdom, Megan. And we're going to wrap it up here. So Barb, final thoughts. Where can people find more about you?
You can find me on YouTube at Barb Friedberg. You can find me at Robo Advisor Pros and at Barbara Friedberg Personal Finance. I will see you all next time.
Great. Thanks, Barb. And Megan, final thoughts from you. Where can people
Kirk.
find you?
So thanks for having me on. You can find me at Forbes.com/Megan Gorman. And, it was great being here.
Thanks for coming on, Megan. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.